that tax equity market out there is real busy chasing other stuff that's pretty well defined, wind and solar. And when we want to take it and get them to pivot and look at hydrogen deals, I think we're going to need to get that guidance as final as we can and to create structures that works tightly within that.
Welcome to the Great Green Upgrade. I'm Jacob Sussman, CEO of Ambient Fuels. Deployment to reach net zero will require a lot of private capital. In this episode, you'll hear from John Eber, a pioneer in financing renewable energy projects. John Eber is an expert on financing renewable energy projects going back several decades. Great to have you with us today, John.
Thanks, Jake. Good to be with you.
Could you talk to us to start off a little bit about your journey in the energy finance sector, and particularly how did you transition into wind power finance?
Well, it's been quite a journey, Jake. It was a journey, started out essentially in equipment leasing, worked its way through oil and gas Section 29 production tax credits, low-income housing tax credits, and ultimately to the wind marketplace. I was working with the First National Bank of Chicago in their leasing division back in the early 90s, and we were brought an opportunity to help monetize some production tax credits in oil and gas for Texaco, of all people. And we didn't know anything about monetizing production tax credits, but we had a client with a big need, and we sensed a new market and opportunity, so we spent a year putting that deal together. We're able to make it happen through a lot of hard work and perseverance. And then we got involved with low-income housing tax credits at the same time. So all during the 90s, I was involved in focusing heavily on energy, but on oil and gas, but on production tax credit investments and monetization. And toward the end of that decade, I met a fellow, Michael Zilka, who ran a company, Zilka Renewable Energy, who you might remember. And Michael told me about his dream to get into the wind power business. And he introduced me to a fellow by the name of Michael Skelly, who's a little well-known in our industry. And between the two of them, they helped educate me on the wind business. And my partners and I spent probably a couple years studying the industry before we were able to finally see some real deals that we thought maybe we could do. And we worked on a couple, one with Enron, a famous name, and the other with a company called Pacificor, that went on to become Iberdrola. And we spent a lot of time on both those deals, and unfortunately didn't get either one of them done. But we learned a lot along the way, and then finally in about 2001, met a couple other really well-known fellows in this industry, Mike Garland and Hunter Armistead, who've gone on to create and run Pattern Energy. And at the time, they were with Babcock and Brown. And Mike and Hunter had developed a structure that made some sense to us, a structure through which we could help them monetize tax credits in a wind farm that they were working on called Sweetwater down in Texas. Mm-hmm. So finally, in about June of 2001, we were able to close our first wind deal with the result of the experience we'd gained over a couple of years of trying, and the help of a couple of smart fellows and good developers in Hunter and Mike, who had developed a flip structure that's gone on to become the foundation for a lot of the other deals, but a structure that looked very similar to us based on all our experience in oil and gas. So it was a great moment. Once we closed that deal in 2001, that year we closed 3 other deals for about $100 million, pretty much all using the same structure, except one of those 3 had project-level debt, and the other 3 were unlevered. So 2001 was really when we turned the corner and really never looked back. In the next 16 years before I retired, we were able to close about $18 billion worth of tax equity deals. Most of that in wind, but, toward the end of that 16-year run, we started doing a fair amount of solar as well.
Boy, what an amazing run, John. And think back, if you will, a little bit to some of those early deals that you worked on. I mean, I heard you say that one took a year to put together, it had some false starts with some of the early ones. And then even once the machine started to get rolling, what were some of the most common challenges that you would run into, especially through the lens of kind of how we can equate some of those challenges to what we'll see here in the early financings in green hydrogen?
Yeah, I've been thinking about that a little bit. And, the first and foremost hurdle we had to overcome was what I'll call forecasting accuracy, right? So we had this intermittent resource, we had these power plants, and we had to gain a level of significant confidence on how much output we were going to have, how many tax credits were going to be generated, right? Because that was the primary source of our repayment. So we spent a lot of time worrying about forecasting accuracy for the projects. And it was really, much of that time was spent early on before we went after the first deals. But as we got involved with deals and started looking at people's forecasts and projections and started thinking about what our external advisors are telling us, we really had to gain a lot of confidence. And when I say we, I mean the collective we. It wasn't me, it was my partners, underwriters in the bank, credit people. We had to spend a lot of time getting our hands around being comfortable with the forecasts. And two other big areas I would mention was, of course, how to structure the investment, because in those days, we didn't have a lot of structuring experience relative to the IRS and or to other authorities, whether it's the lawyers or the other accountants that we're working with. And so we had to learn how to structure the deals. And I'd mentioned of the 30 deals we did in 2001, one was levered at the project level and 3 were not. Well, the only thing we learned out of that experience is we didn't want to do any more leveraged deals because they were massively time-consuming, extremely expensive, and at the end of the day, we were not as comfortable with the risks in those leveraged deals as we were in the unleveraged deal. So structuring the investment was a big hurdle to get over. And then finally, just the size of the investments, the amount of capital we had to bring to the table. If you think about the history of our firm earlier had been doing leverage leases. Well, typical leverage lease, you might put up only 10 or 15% of the equipment cost to get an ownership interest in the asset. So your dollars out the door, even though it was into a leverage deal, were a lot smaller. In these deals, typically we were putting up 50 to 60% of the asset cost, sometimes less if it was solar. So we had to find partners to get together with us, even in our very early deals, which were smaller. So it was a great hurdle to find other firms. It's hard enough to get your own firm to do something new, but to find other firms to join you. But we were blessed. We found a few early movers, Northwestern Mutual, Key Bank, I think of, and ABM Amaro, who entered into our early deals with us. Interestingly enough, none of those other 2 or 3, stayed in the business, and just because of mergers and other issues. But those are 3 major issues we had to overcome to get into the early wind deals. And I'm not sure those are all going to carry over into hydrogen.
Well, in green hydrogen, we use a fuel, kind of like a wind farm needs to measure the wind. We use renewable power, and we have to structure it just so in order to run the electrolyzer. So there's some correlation there. And then certainly, size of the deals, I think, is going to be a factor in green hydrogen as well. And then, in our case, we're fortunate to have Generate Capital behind us and, kind of have our capital spoken for from the start. But
it's interesting. Yeah. I thought about some of these initial hurdles, and then I thought about it in hydrogen. I thought, well, we're now in a marketplace where a lot of people know and understand these structures, and the IRS is very comfortable with them. We're also in a marketplace where there's actually a very significant amount of tax equity, and people know about it. It's not so new. Right. So if I think of these 3 major early hurdles, the big hurdle to overcome now is what I'll call my forecasting accuracy, or the accuracy of our predictions on how these projects are going to work. And that's no small task to get your hands around all the issues that will affect that. But we are in a much better place today than I was in 16 years ago because there's been a lot of ground covered in terms of some of the major early hurdles we've hit.
And thanks to pioneers like yourself and the other executives from the wind industry who you mentioned, who are, have all paved the way for where we are today. But
a lot of blood on that path, I'll tell
you. Well, also, I mean, I guess, there was that period. So you did your first deal in 2001. I came into the U.S. wind power sector in 2005, and I wouldn't say that the flywheel was really going per se. It took a few more years till you could really palpably feel it.
Well, that's true. I mean, there was from 01 to 05 in the wind business, and solar didn't really exist then. We did our first solar deal then, I think 07. But the wind business, there was no guidance from the IRS. But in 2005, they issued their safe harbor for the flip structure. And that structure went on to become the foundation for how many of the deals, the vast majority of the deals, are structured. So once the IRS issued that safe harbor, I think the industry really took off in terms of availability of equity, because there was one major player who wouldn't come into the market until they got that safe harbor, and others who followed them in the market. So 2005 was a bit of a watershed year because of the safe harbor from the IRS. And the deals got really large starting about then, and more capital started coming into the market. So, and quite frankly, the actual predictive capacity of these early wind farms was not great. But starting in about 05, 06, and 07, everybody started learning from the experience they had gained in those early years, and much more comfort was derived relative to how to forecast.
Yeah. So in terms of kind of what kind of got the flywheel going then, it was the safe harbor. And now what we have in green hydrogen is the guidance on Section 45V tax credits. And we're anticipating that that's going to be final later this year. And who knows, maybe that'll be our watershed moment here that gets our flywheel going.
Hopefully. Yeah, hopefully.
Hoping so. Drill down a little bit into the details. So what were some of the key financial mechanisms that were really pivotal in those early days of wind financing? And how could you see some of those dynamics maybe play out here in green hydrogen? Like what were some structural nuances or things that were kind of innovations at the time, things you had to think out of the box in order to, really kind of get some of the projects financed and into construction?
Well, I think about the tax credit, everything that affects the tax credit, because we were focused heavily on monetizing the tax credit. That was the key piece of capital that was missing, for all the developers and other parties who wanted to own and operate wind, is they couldn't use the tax credits. Those of us who are interested in monetizing it were very focused on tax credit risk, right? And so we're very concerned about qualification. We had constantly expiring targets for placed in service. There was only like a year or two. And so we had to focus heavily on making sure the projects were qualified. And, that was a major challenge in and of itself, because they kept expiring and the rules were not well written at the time. Unlike today, where there's a lot more comfort level with it. We're also quite worried in those early days about partnership flip structure that we were using. We were using it, we were investing with it, but there was a lot of concern about it because, the IRS can be unpredictable. And so they could come in and challenge it. I'd say our early work in oil and gas production tax credits gave us, my team, my institution, great comfort with what we're doing. But it was a tough sell to many of the partners we were trying to bring into the business. And so until that safe harbor came out, it was quite a challenge. And we were trying to work those structures very carefully and try not to take too much risk relative to whether or not we might trip up the qualifications. So those are two really sort of early major issues, both of which, I don't see. I mean, there's certainly parallels to hydrogen today for both of those, but they're sort of different issues. Right now, there's been a lot of complexity introduced to the PTC. It's far more the old days, if it was a wind farm, you built it in the United States and it got in by a certain date, you qualified.
Right.
Right now it's fairly complicated. So there's a parallel there that we have to worry about all these new complex rules for the PTC. But fortunately, there's more guidance coming out every day on those.
I hear you saying in the early years you want to keep it a little bit flexible so that you can kind of find ways to work with it. And, as the industry matures, maybe it's okay to get a little more wonky and a little bit more technical, but early on, it can make things a lot more challenging.
Oh, yeah, we're going to have to be very cautious in the early deals, I think, we being everybody. If the developers want to attract tax equity, it's going to be a serious challenge to raise it for the first few hydrogen projects. I mean, you think about it, the blessing is there's a lot of tax equity out there, far more people know about it and are doing it than, when I first got going. But that tax equity, right, very happy, doing straightforward wind and solar deals, and it's very busy, right? And so if we want to draw that tax equity over into something new and different, we're going to have to make it easy for them to come over and invest, easy in the sense of the risks, and we're probably going to have to offer them a better return, than what they're getting. I mean, that's just how markets work. And so I wouldn't be surprised to see that. Just like the early deals I did in wind, I mean, the returns are pretty good. I think our flip returns were, in the 9% range. Nice. It's a 9% after-tax return, and that was just the flip return. Of course, you get something more from the tail. Mm-hmm. And so, and we structured them fairly safe, which, to make sure that we were going to get something close to that. And a number of those deals, we didn't quite get there because they underperformed. But, that was a pretty healthy rate at that point in time.
Note to tax equity providers who are listening, that 9% would be several hundred basis points lower today in this much more mature market, of course.
Yes, of course.
Of course.
Yes.
But actually, you touched on something that's a good segue, John. So what did you see some of those early developers do that made your life easier and that made their deals more attractive for you to finance? And we'll take those lessons into our green hydrogen projects today.
Yeah, I think first and foremost, I talked to a lot of people in the wind business from about 1998 to 2002. And I would tell you that there was a good number of them I just didn't do business with. And I'll never forget, I got a great friend, I won't mention his name, who never let me forget. I turned him down 2 or 3 times, just wouldn't even do a deal. And it's just because we were looking, we were going to venture out into this new business. We were looking for the safest deals we could find. So you need really good quality developers who have some real skin in the game and the ability to invest alongside of you their own money. And that was really important to me then, and I think it'd be really important today. There's nothing that makes a financial firm more comfortable than to have somebody else in there alongside of them, or even more importantly, in front of them, in terms of the capital allocation structures.
Mm-hmm. Yeah.
So that was really important then, and I think it'll be very important now. And then, of course, you always got to have a good project, right? You got to have a very, very good project, and it's got to follow the classic project finance acceptable structures. You got to have really good equipment with good warranties. You got to have really good offtake agreements that you're comfortable with, right? You got to have a good handle on your expenses so you can predict your cash flow. An experienced operator, who can run the project. All those things make a really good project financing. And so, it's not rocket science. This has been going on for a long time. So, good projects, good sponsor, and capital they're willing to put into the game will probably be mandatory.
Been going on for a long time, but we just heard the playbook from one of the best. So that's really helpful to have those kind of bullet points. One of them that you mentioned on the list, John, is offtake. So maybe another drill down moment to take us down into the detail of what really matters on a good offtake agreement.
Well, this is where it's going to get tricky for hydrogen. But, big picture wise, what's going on here? We want to be able to predict cash flow and production that's going to produce the PTCs, right? So we've got to get great comfort into that bottom line. And generally, that's going to start with, of course, you got to have the project, but you got to have an offtake agreement. You got to have a place to go with that production should your plant run. And so that agreement's going to have to be well structured. You're going to have confidence. There's a market. There's a pipeline to get the product to the market. And you want to know that it's going to get there at a price, a net cost that you can confidently predict. In the case of hydrogen, unlike wind, we're going to have a fuel cost of a type, right? Whereas in wind, our fuel's free. You got your operating costs, and then you sell the product. In hydrogen, we're going to have to pay for that power, and so we've got to figure out a way to make sure that the investors get really comfortable with the fact that there's going to be the right amount of cash flow there to pay for the project and get the product out the door and produce the PTCs.
Yeah, we're seeing another increase or interesting nuance that takes me back to my gas-fired power days, which is the sort of back-to-backing of credit from your fuel supply agreements and your offtake agreements, and sort of figuring out where the seams are and kind of how to bridge those gaps. So that's another nuance that's a little different here too.
Oh yeah,
And as you well know, John, we're in a totally new tax credit regime here with this the IRA and Section 45V in particular. You mentioned earlier that there was this sort of seminal moment when the safe harbor came out, and in general that it can be the service can be unpredictable. So what advice would you offer in terms of kind of how to get in front of that, how best to interact with the IRS or with other kind of professionals who are around these tax credits, especially in the early years when it's all new?
Yeah, well, right now I think the industry is doing the right thing, which is pushing very hard for guidance, as much guidance as you can get. You may not like the answer to some of it, but the more guidance we can pull out of them, the more definitive we can get them to make it, the easier it'll be to decide what path to go down in structuring the deal. And right now, it's in a bit of a state of flux. We've got guidance. It's being reviewed and needs to be finalized, and everybody's pushing to try to improve it. So I think we've got to get to an end game on that before we can think about financing. Because whatever that guidance ends up being, once they come back and finalize it, we're probably going to have to live with it for a while, right?
Yeah.
And then we're going to have to figure out how to work around it. And right now, it's very hard to forecast where this is all going to go. And so I think, that tax equity market out there is real busy chasing other stuff that's pretty well defined, wind and solar.
Yeah.
And when we want to take it and get them to pivot and look at hydrogen deals, I think we're going to need to get that guidance as final as we can and to create structures that works tightly within that.
Yeah, and that's another good segue. So how do you, and I actually had one deal that was really important to my company, and we were on the top of the pile for, let's say, a different tax equity provider for a minute, and then somehow we drifted down to the middle of the pile, and that deal ultimately didn't get financed. So we learned this lesson the hard way, that sometimes the capital provider's attention gets pulled over to other deals. So how do we, what would compel a tax equity provider, or in general a project financier, who has wind and solar that they can do, what would make them focus on our deal instead?
There's a number of things we got to think about, but let's face it, our deal is going to be less attractive to them and riskier, right?
Yeah.
Right, because it's new, right? So that'll make it both less attractive and riskier. So I think partly you got to find a few investors who are driven to get into something new, to get out there and be a real mover in the industry, an early mover, and who's focused on their clients and wants to serve them and wants to find a way to get into hydrogen. I did my first solar deals long before I understood solar. I did a solar distributed generation deal in 2010. People didn't want to do them, and I did a utility scale solar deal in 2007. And I just wanted to get our firm out there into solar. So I was driven to try to find a way to get a solar deal done to get on that path, because I wanted my business to keep growing, and I wanted J.P. Morgan to be a leader across the board in all of these fields. So you've got to find a partner who feels that way, because you're going to be out there for the first time blazing a little bit of a trail. So the right partner is going to be critical.
Well, we entrepreneurs can kind of sniff each other out sometimes, and I bet there's going to be somebody out there trying to make a market in green hydrogen and really kind of leap to the top of the league tables. Partnering with that person, through what may be some not all good times, is kind of what enables you to build a long-term relationship.
Right. Well, and the other avenue, of course, is that you may have to do some of the early deals without tax equity, right? And that may be a very viable course of action, or at least you might want to go down both paths at the same time, not knowing whether or not that prospective partner is really going to be able to get there. Because, fortunately, there is, the option now, of trying to do direct pay or trying to do transferability or a few other things. Now, that comes with challenges and risks, because you got to raise a lot more other kinds of capital up front to help, displace that, what traditionally would be the upfront tax equity capital. But, the IRA has given the industry some tools that will allow us to potentially get out there and get some of these early deals financed without using traditional tax equity.
Yeah. No, it's a great point. And especially given we have a refundable tax credit in green hydrogen, there ought to be room for more traditional project finance lenders in a lot of these deals.
Well, and the one thing I've learned over the years is that there's a heck of a lot more project finance lenders than there are tax equity investors. And the project finance lenders, for better or for worse, are quite a bit more aggressive than the tax equity investors. Aggressive in terms of the way they deal with project financing. I think tax equity investors are still very aggressive in the sense of what they have to deal with in the way of long-term tax risk. That is one of those things that's always percolating below the surface, and you never really know whether it's there or not until it comes up and bites you. But anyhow, there's a lot of project finance lenders. They're leaders in terms of getting into new industries. They have a lot of capital they want to put to work. They can be very competitive when they want to do that. So if you can find a way to get them in the early stages and rely on some of the tools that the IRA has given us to initially maybe avoid having to raise upfront tax equity, that's a very viable course of action to contemplate, or to at least pursue while you're pursuing honest negotiations with a traditional tax equity investor.
Absolutely. One thing we haven't talked about yet, John, is just the technology itself. And like wind in the early 2000s, electrolyzers are a proven technology that's been around for decades, but that's still coming down the cost curve, and the manufacturing is still kind of ramping up on a global scale. So how does that dynamic of technology that hasn't been tried all that many times in this setup, How does that factor into successful financings?
Yeah, well, that's a risk because the classic project finance scenario, as I laid out earlier, relies on proven equipment. And so in the old days when we were looking at wind turbines, we spent a lot of time with Garrett Hassan, Andrew Garrett. What a great man. And he helped my firm tremendously before we got into wind and instilled confidence in our underwriters. And one thing I learned from them and spending a lot of time with them and our own internal engineers is that, there's a lot of ways to risk rate, your technologies. And most of the big engineering firms to this day still have, what they'll call a proven concept. They will have a very specific grading scale to determine whether or not something can be deemed to be proven. And so presumably our equipment will be able to get to that point based on the way it's been used anywhere in the world. And to the extent that you can get the right designations from the right independent engineers, that will get, even though it hasn't been necessarily been applied, in the particular way you want to apply it, if the equipment can be deemed to be proven, you can get a long ways down the road to make investors and lenders comfortable that it's going to work. And, that's where you want to bring in the right external independent engineers, get the right reports and blessings on your plant that you can then deliver to the prospective lenders and investors to help them get comfortable that it's going to do, what your project model says it's going to do.
Yeah, it was a very victorious moment back in the day in wind when you could drop that Garrett Hassan independent engineering study on the table and say, here, finance this. So absolutely. Any kind of general advice or parting words you'd like to offer, us gung-ho developers here of the next generation of decarbonizing green hydrogen fleet? Well, as we run into our financing fires here?
Well, I will say this. First of all, I think the way all these new businesses get started is with serious commitment and perseverance. And so, this is an industry that needs to be successful. I believe it'll be successful. And it's got, all the tailwinds behind it that are necessary to get there. But it's going to be, a few challenges to get the first few deals up and running and finance. So people just need to be committed to their mission, and they just need to keep pressing forward, to make these deals happen. And really, I don't think we're trying to reinvent any wheels here. We're just trying to do one more somewhat new type of project, within the constraints of a long line of other projects that have gotten done. We've got lots of capital out there that wants to get into this industry. We've got a lot of really smart, capable people. We've got the government support behind it, the tax benefits. We've got technology that isn't exactly, it's not nuclear science, So there's and these projects are nowhere near as complicated as a lot of other things in this world that get financed. So we just got to keep pushing forward. Just like they say sometimes in football, it's just a lot of blocking and tackling to move the ball up the hill. And I think we'll get there. Just everybody's just got to stay committed to the mission.
Great way to close out, John. And frankly, the whole discussion is rather soothing because you're right. We are staring into some, new challenges, things that have been tried for the first time or one of the first few times on the one hand. On the other hand, we're fortunate to get to benefit from the great work that pioneers like you've done and a lot of other developers, not just in wind and solar, but frankly in other kinds of project financed, assets that have been built over the last many decades. And so, we have to tweak some things. We have to maybe take a slightly different approach to this tax credit, to this technology. But there's a lot of lessons that we can draw on from the past that will just apply in a new way here. So, Anyway, this has been a great conversation. We really appreciate it, John. And thanks for kind of getting out there in front of these last couple of waves, and we'll check back with you soon on how we're doing in this one.
All right, thanks for having me, Jake. Look forward to working with it.
Likewise.
Take care.
Thanks, John. For more episodes, go to ambientfuels.com. Also, follow us on LinkedIn for more green hydrogen news. Thanks for listening, and see you next time.